Hello guys, welcome to another YouTube video where I'll be teaching you how to master demand and supply. In this video, I'll be teaching you my full strategy on how I make money from the market using demand and supply. If you've been struggling to stay consistent in the market, this is a demand and supply strategy that will change everything for you. All you have to do is to stay consistent, because the truth is, most traders don't have a system. They just jump from one strategy to another, hoping that something works. So before we go any further, if you want to learn demand and supply the right way, ensure you subscribe and hit the notification, because this is where things start coming together for you. Now let me show you the exact approach that this strategy is built on that helps me make money in the market regularly. Before we head on to the charts, I would like to explain to you the stages step by step right here, so that when we get to the chart it will be easier for you to understand. Okay, so I'll be explaining to you the demand and supply stages, so that once we get to the charts it's easier for you to understand. So here are the stages. So I'll be taking them one after the other, explaining them in detail, so that once we get to the stage of using it on the chart or following the stages on the chart, it's very easy for you to understand. So let's proceed. The first stage, okay, let me just pull it down here. Stage one is to identify the market structure or the market bias. It's very common in trade that it is best for you to determine the structure of the market, so that you will not be fighting the market. Okay, if you're just trading every demand and supply zone you see, no matter how accurate you are, and you're not making sure you're aligning with the trend of the market, you're actually fighting the market, and on the long run you may not be profitable. So what are we looking for? Okay, the first thing we need to do is to go to the daily time frame, all right, to check out our daily bias, okay, to know what the bias of the day is, so that we'll know if we're trading to the upside or we're trading to the downside. Okay, so once we get to the market, what we're looking for is to know if the market is bullish or bearish. All right, so if the market is bullish, you should be seeing something like this: higher high, higher low, higher high, higher low, higher high, higher low, higher high. This is a typical example of a bullish market. All right, so if the market is bullish, this is exactly what we want to see. Market breaking structure as it goes up. This is the previous structure. It broke it here, continued up, came down again, all right, moved up again, broke the structure again, broke the structure here again, and then continue higher. This is a typical example of a bullish market where we're creating higher highs. All right, now we are also looking for bearish market. So for a bearish market, what you should be hoping to see is the market going this way, lower high again here, lower low, lower high, and lower low. So once we see this is a typical example of a bearish market. All right, why? Because the market is taking the structure as it goes down. All right, breaking structures as it goes down, took out the structure here, and then also took out the structure here. So if I see this, I'll know we can trade because the market is on downward trend, and when I see this, we can also trade because the market is in an upward trend. What we don't want to see, or what we don't want to trade, is when we see the market moving like this. You see the market moving sideways, not breaking the low and also not breaking the high, just moving sideways continuously. This is the market we want to avoid. There's no structure being broken. The market keeps moving up and down. This is a typical example of a ranging market, so we want to avoid a ranging market. We're typically looking for higher highs, and higher lows, or lower highs and lower lows, meaning upward trend and downward trend. Okay, if you're not doing this, if you're not following this to higher time frame direction, which is usually on the daily time frame, then you are fighting the market. All right, you're fighting the market. So having said that, let's move to the next stage, which is stage 2. So on stage 2, let me pull down my, okay, On stage 2, we're locating the strong zones, to confirm our base and our move. All right. So what makes our base? Our base is equal to small consolidation. So our base must be a consolidation. All right. Any strong move we see must be an impulsive candle or a decisive candle. All right. So once we see those, we identify our demand, and then we also identify our supply. Okay. So for a demand zone, what we're looking for is a drop-based rally. All right. For demand zones. Okay. Markets coming in, giving us a base, and then rallying up. All right, is what we're looking for. Or for the supply zone, which is the bearish market, what we're looking for is a rally-based drop. Okay, rally-based drop. Let me get my drawing tools. All right, for a demand zone, we're looking for what? A drop-based rally. So we're looking for something like this: the market drop, create a base, all right, and then rally up. Sorry, pardon my drawing. Okay. Market drops. That's crooked. Let me just delete it and redo it again. Okay, so the market drops aggressively, creates a base, and then rallies up aggressively. Okay, this is what we're looking for. Another scenario we can be looking for again in this bullish market is a rally. The market rallies up aggressively, creates a base, and continue to rally up again. This is called a rally-based rally. All right, it's a rally-based rally. So these are the two scenarios we're looking for a bullish market. So this is scenario 1 and 2. Okay, when we get to the chart, you'll be able to understand this better. For the bearish market, the situation we are looking for here is a rally-based drop. So the market rallies up, all right, creates a base, and then drops down. Okay, so this is a rally-based drop. Another scenario we are looking for could be a drop, the market creates a base, and then continue dropping. So all this is aggressive drops, aggressive drop here, aggressive drop here. This one aggressive rally, a base, and an aggressive drop. So on a bearish market, I automatically know that we are looking for this sign, these two scenarios inside this candle here. So all I need to do is just to go down to a 4-hour time frame and look for this. I look for 1 and 2 for a bearish market, and then for a bullish market, I drop down to 4-hour time frame and look for this one and this. Drop, base, rally, rally, base, rally. Okay, our rally, don't forget, must be either decisive or impulsive candles. All right, here should be a base, regular candles, and here should be another rally, decisive or impulsive candle. Same thing here. This rally here before the base here, it must be a decisive candle, while the rally here after the base must be also either a decisive or an impulsive candle. Same here. So these are just the scenarios we are looking for before we can take a trade. Because if you take a trade on a market that does not give you an impulsive rally or an impulsive drop, you might not be profitable on that trade. Okay, let me give you another example of kind of candles we're expecting. Let me draw the candles here so it will be easier to see. Here we have, pardon my drawing please, here we have a candle. Let's assume this is a candle, with a tiny wick at the bottom and a tiny wick at the top. All right, now if you look at this candle, you will see that the body of the candle is at least 50%, more than the wick of the candle. So this is a decisive candle. All right, this is a decisive candle. Now let's look at this one. This candle here, okay, this candle here, pardon my drawing again, this candle here does not have any wick at all. All right, this is an explosive candle. All right, then let's look at this another candle. This candle here, okay, may just have one wick at the top. This is a decisive candle. All right, the kind of candle we don't want to enter is a candle like this, where you have a candle, all right, where the wick is bigger than the body, or the wick is almost half of the body. we want the body of this candle to be at least 50% bigger, than the 50% bigger than the entire candle. All right, the body of this candle has to be 50% bigger than this entire candle, at more than 50%, not at least, more than 50% bigger than this entire candle. That is when we can call it a decisive candle. All right, anything less than that is a regular candle. Okay, again, size matters. Size matters a lot. All right, for example, you can have an explosive candle, all right, that is, tall and giant, and then you can have an explosive candle without a wick, but a small candle. This is not the kind of candle we're looking for. All right, it must be explosive, pushing out of bigger than, in fact, the easiest way to note is that it must be at least 70 to 80 times bigger than the regular candle on the base. All right, so if I have a base here, if the candle that pushes out here is at least 70 to 80% bigger than this, okay, is a decisive candle, bigger than most of the candles here. This single candle is 70 to 80% bigger than most of this candle here, so we're having a decisive candle. You understand? So that is what you should be looking for. Size matters, and you must not neglect that, because if you do, it may not be profitable for you because the candle is not decisive. So take note, the size of the candle matters, the type of the candle matters. It has to be either decisive candle or an explosive candle. Okay, do not use any other candle like the hammer or any other. No, just focus strictly on decisive and explosive candles. All right, let me get rid of this so that we can continue. Okay, so after we've done this, we move to stage 3. So on stage 3, what we're having here on stage 3 is filter the zone. Filtering the zone just means inspect the quality of the zone. All right, it's another simple step. First of all, we know that all zones are not the same. All right, it's very important to note that all zones are not the same. Okay, so good zone, like I explained to you, must have explosive candles. All right, a good zone must have an explosive candle coming in. All right, let's assume is a bullish situation, creating a base, okay, and then pushing out. All right, the candle has to be explosive or decisive. Very, very important. Very, very important. Okay, and then must have a clean structure. All right, this is not a clean structure. If it's moving, sideways, it is not a clean structure. This is a clean structure. Breaking, the previous high, breaking previous high. You know that this is a clean structure. Same thing here, breaking previous lows. We're having a clean structure. All right, so it must have what? A clean structure. Under quality check, all right, which is number 3, it must be a fresh zone. Okay, so if you're marking out a base as your zone, right, this is drop, base, drop. Remember, it is the base that we are marking out. Okay, so if you're marking out the base as your zone, ensure that that base is a fresh zone. For example, let's say this is our base, so we'll mark out the base. All right, let me push this again. All right, for our candle, and then here a base. Okay, what we don't want to see is for the market to break structure and tap in here, move up and then come back and then we enter. No, it must be a fresh zone that the market has not tapped into yet. Very important, the market must not have tapped into it. Let me get rid of this. Okay, hold on. Okay, so the market must not have tapped into it, like what you're seeing here. The market must not have tapped into it. All right, once the market taps into this zone, the zone becomes invalid. Okay, so it must be explosive candles, it must be fresh zones. I keep hammering fresh zones. This is very important. The zone must be fresh zones. Okay, so that your base must be a fresh zone that the market has not yet tapped into. All right, then it must have caused a break of structure. All right, so as the market comes here, create the base and pushes up, it has broken structure here. Okay, so when it's coming back in, we can enter. Beware of market that did not break structure, all right, before coming back into your zone. Okay, so let's assume that, for example, let me get my drawing tool. For example, this is the market coming into this zone here aggressively, creating a zone and then pushing out. If it doesn't take out this high, If it doesn't take out this high that creates the zone and then decides to come back, I'm not going in for a trade. You don't need to go in for a trade. Okay, it could be a trap. Don't just go in for a trade. There's a high probability that this trade will not be successful. It will not play out. All right, so always look for zones that once you move out of the zone, it broke structure. Okay, it broke structure here, and then as it is coming back, you're entering to go up. All right, to continue the trend, just like we're seeing here. Okay, so this is a zone and this is another zone. So we're expecting the market to come back. So I'm having 1, 2. I can also have another zone here. Where's my rectangle to here? I can also have another zone here. So when the market comes in here, after breaking structure, I can go in. If the market decides to come back in here, because we've broken structure here, I can also go in. If the market decides to come down to this last zone here, all right, because we've broken structure here, I can also go in. So it is that simple. Same thing applies to the bearish condition as well. Okay, so let me just take that again. So that let me take that one too, so that you see it. So this, for example, this is a zone. Okay, we have another zone here. Okay, and another one here. Okay, so because the market has pushed down, broke structure, pushed down below the candle that formed this particular zone, all right, it is now a valid zone for us to, mark it out. So once you have the break of structure is a valid zone, break of structure is a valid, this becomes a valid zone. You understand? So that's how, to mark a very good zone. Without the break of structure, this zone is not valid. It has a high probability of failing if the impulsive move did not break a structure. Okay, so you must always ensure that structures are broken. Okay, the BOS or whatever, most people call it BOS, break of structure, is still the same thing. All right, so now what we want to avoid is a bad zone. A bad zone in the sense of a choppy market. Okay, a market that it's not moving decisively. Sometimes you have markets, break structure here, come back here, break structure, go down here, break structure. Okay, so this market is not really the kind of market you want to trade. Okay, because you're not seeing any decisive move, or the candles are very chubby. It is not aggressive. The moves in and out of the zone. For example, this drop based rally. Very difficult to draw with this though, but I'll just try. So we have small candle, small candle, coming in to form a base. Okay, coming in to form a base. Okay, and then most people, because they see a huge rally to the upside, all right, with a decisive or impulsive candle, they forget that this one is also very important. Okay, the candle that's coming in here has to be decisive or explosive. If it comes in chubby, it is wrong. If it comes in decisive and also goes out chubby, okay, no, it's not a valid zone. Just let it go. Okay, let me clean this off again. Just look for another currency pair to trade for that day. Is a very, very wrong zone. All right, so let me wipe this off. Okay. All right, so I believe you get the idea right now. Always look for decisive candles. It's very vital, very, very, very vital. Okay, and then too many ways coming into the zone. For example, sometimes you have the wick touching here, touching the zone, touching the zone, touching the zone, before you now have the body enter the zone. Those kind of trade I would not want to enter. All right, this kind of trades I would not want to enter. Okay, and then I already tested zone. No, it's something I don't want to do. Okay, so number 4. So number 4, we wait for price to return. Okay, so after we have marked out our zone, all right, the next thing we'll do now is to wait for price to return, to come back to us. It's very important that we wait for the price to come back to us, because that is when we can now look for our trade entry. All right, wait for price to come back to us. Don't chase the price. Never chase the price. Once we have that move, once you have that move up, okay, allow price to do its thing, okay, and then gradually come back to your zone. When it comes back to your zone, this is when you now look for a good entry. Do not because you're anxious to trade, or you're just looking for a trade setup, you must trade, you must trade, you must trade. You meet price halfway, okay? Because you saw something that looks like, you know, an entry, and then you enter to go up. You may lose the trade. You may lose the trade. So don't try that. Just wait for the market to come back into your zone. Once the market is in your zone, then you can take your trade. Very, very, very important. All right. And then if you have any reason to see that price is not coming into your zone, just look for another currency pair. Just look for another currency pair. All right. So for me, I mark up to 5 currency pairs in a day. I just wait for the market to come into any of the zones, to move to a lower time frame, try to get my entry, and then we trade to the upside or trade to the downside, depending on what our bias is for the day. All right. So be very, 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 very careful. All right. Do not chase the market. Allow the market to come to you. It is very vital. All right. Let me clean this again. Okay. So after stage 4, our next stage is stage 5. All right, so stage 5 is we refine our entry. Okay, refine our entry is a very important concept. That means this is where we now go down to the lower time frame. Okay, at the lower time frame, which is 5-minute time frame. Okay, let me get a drawing tool. So this is our drop base rally. Okay, I zoom in. Then this is our zone. All right, the 4-hour zone. So the market comes in, gives a base, pushes out, of course, very important, broke structure. All right, we can see that it broke structure here, and then did his thing, and then eventually came down into the zone. So what we want to see is the market coming into the zone. Okay, this part may be, you know, not quite clear, but when we get to the chart, I'm sure you understand it when I explain it better. So what we're looking for is a break of structure. Take note of that. A break of structure, okay, a strong rejection candle, okay, and an engulfing or momentum candle. All right, so this is what we're looking for in stage 5. This gives you a precise entry. Okay, that's what we're looking for, you know, in stage 5. But this is done on the 5-minute time frame. Please do not forget this 5-minute time frame. That's where we're looking for that particular, you know, entry. So let's move to the next stage, stage 6. Okay, what we're doing now is managing our trade. All right, once we see our entry, okay, now we enter the trade, and then we're ensuring that our trade is taken inside the zone, all right, or above the zone. The most important thing is that the market has entered the zone and is, you know, around the zone. We got an entry either here or above, or just a bit below. But the most important thing is that it happened, you know, in and around here. Okay, and then we place our stop loss. I look at the structure. Okay, most times I place it below the structure that was created inside the zone on the 5-minute time frame. Okay, that's what I look for. Okay, then my take profit is usually 2 to 1. All right, however, if I'm trading on a 4-hour time frame, which I hardly do, but sometimes I take trade on the 4-hour time frame, I just go for 1 to 1. As long as I know my zone is, you know, all is correct, I go for a 1 to 1. All right, but I don't do that anymore. I just go straight down to 5-minute time frame, look for my entry, enter for a 1 to 2 risk to reward. I hit my TP and I take my profit. Okay, so the next stage is the 7th one rather, which is review and improve. So after the trade, it is very important that you review your trade. Okay, what makes the trade successful? What did you see that is different from what you saw in the past? Okay, jot this down, take notes, and then improve on them. Then any break-even trade, what I do is I journal it and I write the reasons why this trade was a break-even trade. Okay, it's very important. Okay, then if I'm taking partials, I'm also writing it down. I took partials. This was the reason why I took partial. Subsequently, as you move on this journey with me, you begin to understand and learn how I do this effortlessly. Right now, it may seem very difficult, you know, but as you journey with me, you begin to learn how I do this effortlessly, and I'm sure you'll be better off for it. Okay, so after the trade, don't forget to write in your journal if the trade followed your rules, or if you followed your rules. Did your zone follow the rules? All those things you need to know. All right, write them down so that when you discover that your trades are losing, you can go back to your journal and see where the error is coming from. Okay, did you wait for confirmation? Because sometimes you may be so The anxiety may be there for you to trade. You forget that, okay, there's one more confirmation that I need to get. Those are very wrong, okay? It's not something that you should be doing. Always make sure you wait for your proper entry. Get all your confirmations right, okay, before you enter any trade, okay? So if you can follow all these steps, okay, all these stages I just outlined now, okay, it is the surest way for you to grow fast. All right, demand and supply is something I've been trading for a very long time now, and it has been making me money in the market. I am telling you honestly. So this is the end of the explanation for this strategy. I would have loved to take you straight to the chart so you can see how it works on a real chart, but as you can see, this video is already too long. So I'll be making a part 2 of this video where I'll be showing you how I execute this strategy on a chart. Ensure you subscribe and turn on notification so that you don't miss it. See you in the next video.